Mm. Okay, hi, good evening, everyone, and welcome to this revision session for Quiz 2 for Corporate Finance. And thanks for joining, first of all. And second, the agenda for today is that we will revise the concepts of week 5 to week 8. And what we will do, we will go through the GAs, and along with the GA, we will cover those concepts also. And maybe tomorrow I'll keep a maybe 15 to 20 minutes of session just for the previous year question paper. That will be tomorrow. Yeah, can we start then? Somebody can give me
Yes,
answer.
please. Yeah,
Yeah, thank you.
sure.
Thank you. So I'll share my screen. Hi Vivek, good evening.
Hi, good evening.
How are you?
I'm good.
Yeah,
Thank you. Thank you for taking this session.
yeah. Okay. I hope my screen is visible to all of you.
Yes, it's visible.
Yeah, okay. Okay, so we'll start with week 5. And week 5 was generally about the expectations, expected values, and then converting them to present value and rate and all that. So let's see the questions from the GS. Okay, so the first question is consider a bat based on a fair die. And if an odd number comes, then double that value is paid. And if an even number comes, then half of that value is paid. So they have given an example. So these are the outcomes. So if we get 1, then we are paid 2. If we have 2 comes, then 1, 3, 6, and like this. So what is the fair price of this bet? Fair price will be the expected value. So we know the probability of each outcome. It is 1 by 6. So we add up all the values and divide by 6. So we get 4. The standard deviation. So these are basically just warming up questions. So we know that standard deviation, we can find the variance. Variance will also be the probability. And then what is the value minus mean, expected value. So we add up all that, divided by again by 6. So we'll get the variance. And from variance, then we can find the standard deviation. Next question is, suppose a 1 year government bond is offering an 8% interest rate. You have rupees 100,000, yeah, which you can invest in government bonds or lend to your friend Raman. So you believe that Raman will pay back the promised amount with 90% probability, will pay back half of the borrowed amount, and with a 5% probability, and will pay back nothing with a 5% probability. So how to solve these kind of questions? First of all, you have to see that is what is my risk-free return. So if you invest in a government bond, that is considered risk-free. So if you invest for an year, then you will get 1,08,000. So this is the minimum amount which you will expect from Raman in all the scenarios. So we consider the from Raman. So let's say he is charging rate R. So the expected return from Raman will be 0.9 probability, that is 1 plus R into 100,000. Then 5% probability that he will return only 50,000, and 0 probability, 0.05 probability of returning 0. So this becomes 90,000 plus 90,000 R plus 2,500. So this we have to equate with our this 1,08,000, and then we get the R. So this is the rate of interest which we have to charge Raman. If we charge less than that, then we are in loss. That is all. Then what is the time premium and default premium? So just this concept, time premium is the risk-free rate. So whenever this question is asked or you see this term time premium, so this is the risk-free rate, which is 8% in this case. And default premium is the rate of interest which you are charging minus time premium. So in this case, it has come 17.22. So 17.22 minus 8% will be your default premium. Okay, now we come to next question. Rakesh, a risk neutral person, has two investment options. Invest in government bonds, which pay 9% interest, so same concept. Second, invest in a project that pays a 50% interest rate if successful, and pay only 75% of the money back if it fails. So if Rakesh is indifferent between these two investment options, what is the probability of the failure of the project? So we see the option 1, 9%. So if he invests 1, so he'll get 1.09. In option 2, he has got probability. There are two probability of success and probability of failure. So let's take P success. So in this case, he will get P into 1.5. This is the 1.5 plus 1 minus P. He will get only 0.75, 75%. So you equate now this term with the 1.09 to get the P. So P comes around 34 by 75, which is P success, and P failure will be 1 minus P, which becomes 41 by 75. So here I will just take a minute just to cover one concept, risk neutral, because here they have given risk neutral, risk loving, and risk averse. So I will just give their utility functions. So generally the risk neutral which is there is like k is constant, x is the value, and here it is y. So in this case the y is less than 1. So sorry, for the neutral y is equal to 1. Y is equal to 1. For risk loving, again kxy, but y is greater than 1, and for risk averse generally y is less than 1. So from the utility functions also you can make out what is the risk nature of a person. Okay, now we come to next question. You take a contract to build a road. If weather conditions are good, it will cost 80,000 to build the road. Weather conditions are bad, it will cost 1,20,000 to build the road. There is 60% chance the weather will remain good, so 40% weather will be bad. If you expect to collect 110,000 as toll payment after the completion of road, what is your expected rate of return? So remember, always in these kind of questions, you have to find the rate of return in both the scenarios and then use the probability to find the expected rate of return. So in condition good, your return is 110,000 minus 80,000 by 80,000, which is 3 by 8. In bad, it is 110,000 minus 120,000 divided by 120,000, which is minus 1 by 12. Because you had spent 1,20,000, you're getting, and now use the probability to find the expected rate of return. Okay. Next question is, consider the following payoff table for a small bakery business. So they have given the different states: bad, normal, good, probability, and the value. So from here, the first question is, what is the present value of the business? And they have given 8% per year. So see, these are the cash flows which are after 1 year. So after 1 year, this is the expected value, which comes around 38,000. Now the present value, they're asking the present value. We know the formula for present value is 38,000 divided by 1 plus R, that is 1.08. So this is your present value. Now the following question is, suppose an investor wants to finance the bakery business with a mortgage loan of 30,000 and the remaining amount as equity in the business. So equity, what does it mean? That value is 35,185. 30,000 comes from loan, and 5,185 will come from equity, means the owner will put his money. So what would be the appropriate promised rate of interest rate that a creditor of a mortgage loan would demand? So here we have to see all the three scenarios. So we see the probability of 0.3, only earning will be 20,000. So the guy who has given the loan, he will get only 20,000. In case 40,000, probability is 0.5, then he will get all his money which he has got. So this is 30,000 into 1 plus R. So if the rate is R, so in both the scenarios, 0.5 and 0.2, he will get his money. So his expected is 0.3 into 20,000 plus 0.7 into 30,000 into 1 plus R. And which should be equal to, if he has invested in government bond, which is 8% per year, so then he should get 32,400. So you have to equate this to find the rate. So we get 6,000, 21,000 plus 21,000 R is equal to 32400. And from here, R we get 0.2571 is equal to 25.71. So this is the rate of interest he should charge. Okay, let's delete this. Okay. Second is what is the expected payoff for the equity owner. So equity owner, how much he has invested? He has invested 5185. And in case probability of 0.3, the entire money will go to the guy who has given you the who has given him the loan on this mortgage loan. So he gets 0. In case of 0.5 probability, he earns 40,000. He returns back. Now we know the rate of interest which the guy is charging him, 2571. So he will return 37,713. So he gets back only 2287. In the third scenario, he earns 60,000, returns this 37713, and he gets 2287 with a probability of 0.2. So his expected value, we can just do this way: 0.5 into 2287 plus 0.2 into 2287 is 5600.9. Okay. Till now, any question from anybody? Jalesh? Or any addition? Vivek?
No, it's clear. It's clear.
Yeah. Okay, good. Okay. Now we come to what is the standard deviation of the rate of return from the mortgage loan. So to find this, what we have to find the rate of return in all the scenarios, and it is for the mortgage loan. So for the first case, when he is getting only 20,000, his rate of return is 20,000 minus 30,000 divided by 30,000 minus 1 by 3. In second case, when 40,000 is earned, he gets his money back 37713. So his rate of interest is rate of return is 25.71. Already we have calculated. And in this case also 0.2 also he gets his money back. So average return is 0.3 into minus 1.1 by 3 and 0.7 into 0.2571, which is he's charging. So this comes to the same 8%. We have just done the calculation. Otherwise, straight away we know that 0.2571 we had calculated from 8% only. So here also the average value will come 8% only. So to find the standard deviation now, we use these values which are there. So we find the variance with the probability of 0.3 minus 1 by 3 minus 0.08. Then 0.7 he is getting his entire at 0.2571. Sorry, here typo. So the variance is 0.7238, and we can find the standard deviation. Similarly, for the equity also they have asked. So without calculating, we can just say that average his return will be 8%. And then using his returns in all the scenarios. So like in case of 20,000, his return is 0 minus 5185 divided by 5185 because he had invested 5185. So his return is -1. At 40,000, he's getting only 2287. So it is in minus. And only in third case, he's getting 2287, which gives him 3.29. We put this values in the formula for variance. We get the variance, and from there we can find the standard deviation. Okay. On the same concept, okay, the same question is there. How? So this question is slightly tricky. That's why I have written also here. Mercury Inc. This has demonstrated the design of a new product. So it is only in the design phase. The value of the product is based on the ratings received in the design demonstration. Assume the appropriate expected rate of return is 10% for the period of product development. So it is just in design phase, and then it will be launched and it will get completed here. So the expected values we will calculate after 1 year based on these ratings with the probability and the value. So we use the same formula, so we can combine this 20%. So expected value is 19750. So the present value will become 19750 divided by 1.1 is 17954. So this is the first calculation. Now second question is, if this company wants to borrow 15,000 today, what does it need to promise to pay back at the launch of the product? It is simple that, okay, just 15,000 into 1 plus R, which is 16500. The third part is, what is the promised rate of return for a loan that is promised to pay 20,000 at the launch of the product? So expected payoff, again, now we have to calculate from all these conditions. See, if in the case, if somebody is earning only, payback is 10,000, the probability of is 1.1. 0.2 is 15,000 and 0.65 probability is to pay 20,000. So when we add this, we get 17,000. So payback will be 17,000. We get the present value of this is 17,000 by 1.1, which is 15454.4. So this much loan can be given. So if you give this much of loan and payoff is 20,000, then we can find the rate of return is 20,000 minus present value divided by present value is 29.41. Is this okay? This one?
Yes, it's okay. Yeah.
So the only trick was here that this 25,000 and 30,000 which is there, 35% and 10%, here also we are taking it as a 20,000 only because we are paying back 20,000. Okay.
If the payback is 30,000 or some other value?
No, they have given in the question 20,000 payback.
They are given, but if it is in case.
If it is 30,000, then you will take only 10%. Only in that case they will be charged.
Okay.
Okay.
If it is 15,000, we will make 20,000 as 15,000, right?
Yes. Then entire all this will become 15,000.
Got it. Yeah.
Okay. So we go to next question. Suppose the appropriate expected rate of return is 20%. A project offers to pay back rupees 150 in 1 year and rupees 100 at an investment of rupees 100 today. There is 20% chance that the project owner will default and pay only rupees 75 next year. So what you should do? So just we calculate the expected value. So expected value comes 135, and in here they are asking net present value also. So we know to find the NPV. So NPV is your investment plus present value, which is 12.5. So your NPV is positive, so you should invest and with the NPV of 12.5. Okay, already they are given. For an individual, the utility function is uses root C. So root C is C 1 by 2 is less than 1. Therefore, he is a risk averse person. Next question, consider a game in which a fair coin is tossed twice. If head comes, the value of the participant money doubles. If the tail comes, value halves. If participant has rupees 100 at the start of the game, what is the expected amount after the game? So we take all the 4 scenarios, head, tail, head, and tail, and what is the final outcome? So 400, 100, and 25. Probability is 1 by 4 for all. So we add and we get the expected value. Next is Sham has 100 rupees. He is considering a gamble that pays rupees 400 on winning and nothing in case of losing. There is a 25% probability of winning the game. His utility function is given by root C. Should Sham pay the gamble? So for these kind of questions where the utility function has been given, so we have to find the utility. So his present utility is root of 100, which is 10. In case he gambles, so and his winning probability is only 0.25, he wins 400. So his utility function will give utility of 5. 400 root is 20 into 0.255. So his utility which he'll get by gambling is less than his present utility. Therefore, he should not play. If it, for example, here, if this utility function would have been something different, then you use that utility function. Okay, for a risk-averse individual, which of the following statements is true? They will always choose the highest expected value. No, it is done by the risk-loving people. They will accept a lower expected value in exchange for reduced risks. Yes, because they are risk-averse. They will only accept zero risk outcomes. No, they can take some risk depending on their utility function. They will choose options with the highest variance. No, never. The risk loving they can do, but risk averse will never go for the highest variance. Next question, ABC Bank has assets liability, capital, and so here the concept is banks have got assets, they have got liabilities, and they have got capital. So first is your capital ratio. Capital ratio is, or CR is equal to capital by assets, and the leverage ratio, how much leverage they have got, LR is opposite of that, is A by C. So they have asked the same question, that they have asked, first of all, we have to calculate the capital ratio for both and the leverage ratio. So capital ratio for A is 100 by 500 is 0.2, for B is 0.25. Therefore, the capital ratio B is greater than A. And it is opposite for the leverage ratio. For leverage ratio for A is 5, whereas for B is 4. Then question number 20, suppose the expected rate of return on assets is 8%, expected rate of return on liabilities is 6%. These rates are same for both banks. What is the expected profit per unit of capital? So what we have to do, we find assets. So assets is 8%. So for A, assets is 500. So he will get 500 into 0.08 is equal to 40. On liabilities, his paying rate of return is 6%. So his liabilities are 400 into 0.06. So he's paying 24. So 40 minus 24 is his net profit, which is 16. And now to calculate per unit capital, you have to take 16 by capital, which is 100, which is 0.16. And same thing you do for XYZ. And it comes out that the profit per unit capital for A is more than B. So with this, I have finished the GA part of week 5. If anybody wants to give some new addition or wants to raise any query, I'm ready to take on. Or we can take 2 minutes of break before we jump to week 6. Is that okay?
Yeah, sure.
Yeah. Okay, so week 5, the concepts are slightly easier. There is no problem. It is expected value, present value. Okay. Yeah. So shall we move to week 6? Okay.
Yes, we can.
Okay. So week 6 is it started with the insurance concepts, and so the first question is from that concept only. Assume there is a 10% chance of a road accident. An individual can purchase accidental insurance for ₹1 for coverage of ₹100. Naresh has a wealth of ₹100,000. If he has an accident, he faces a loss of ₹80,000. So 2 states have been given, accident and no accident. In case of accident, he loses 80,000. So he has got a wealth of 100,000 and he loses 80,000. In case of no accident, he has got 100,000. Here he will get only 20,000. Okay. So if he consumes all the wealth available to him, what is the expected value of his consumption if he takes the insurance cover of ₹50,000? So see, how do we take on this question? That first of all, we consider that his wealth is 100,000. And he has taken an insurance coverage of 50,000. It means he has paid 50,000 divided by 100. So his wealth in the starting will be 100,000 minus 500. So it is 96,500. And which is the state for no accident. So no accident, he is left with 96,500. In case he meets with an accident, so he started with 96,500. He loses 80,000, and then he gets from insurance 50,000. So his state is 69500 in this case. So expected value, now we know in both the states, and the probability is also given. So probability of meeting with an accident is 0.1 and not meeting with an accident is 0.9. So expected value is 0.9 into 96500, sorry, 99500, by mistake, 99500 plus 0.1 into 69500. So this is the expected value, which comes 96500. Is that okay, this question? The concept wise?
Yes, it's okay. Yeah.
Yeah, okay. Now, the second question was, I could not understand when I attempted this GA. Later on, I could ask GPT and it gave me an answer. Assume consumption under an accident is on the horizontal axis and consumption without an accident is on the vertical axis. What is the slope of state contingent budget constraint? So, what I found out that, for example, when he takes an insurance for 50,000, then he has got 99500 in the low accident state, and accident state is 69500. Now, if he increases, for example, his insurance to 60,000, then in no accident state he pays 600 rupees. So his no accident state is 99400, and accident state is 99400, loses 80,000, gets 60,000. So his value is 79400. So the slope is your y axis is they have given consumption without an accident on the vertical axis. So it is y2 minus y1 divided by x2 minus x1. So 99400 minus 99500, it is minus 100. Here it is 9900. So from it comes minus 1 by 90. We move to next question. Simran has an income of 1,000 units, which
1 minute.
Yeah.
So is it they have given like paid premium is 600 or something in the question?
What they have given?
Like I'm just asking, let him take insurance for 60,000. You have mentioned, right?
No. So what I did to find the slope, see, to find the budget constraint slope, you have to change the values, then only you can find the slope.
Yeah, correct.
Okay.
Okay. So we can take 70,000 as well, right? 70,000.
Yes.
Oh, then fine. Yeah.
One easier method would be you can
Haan
see it
ji.
in this way: coverage upon coverage minus premium.
हाँ Vineet,
The simpler method would be coverage upon coverage minus premium.
coverage upon coverage minus premium.
Yes,
Okay.
and
So
slope is always negative, so minus.
okay, so it is, for example, 50,000, then 50,000 minus 500.
Yeah.
Yeah. Okay. Thanks, Abhineet.
But उससे slope नहीं आएगा ना, the denominator is will be lower.
इसमें 50,000 by 4,950 हो जाएगा.
Coverage was 100 and premium was 1 rupee.
हाँ.
I guess.
Okay.
Coverage was 100 and premium was 1 rupee.
Okay, so it will become.
Sorry. Premium upon coverage minus premium. Yeah. Premium upon coverage minus premium.
Inverse आ जाएगा उसका. Inverse will be the correct. Yeah.
Okay, premium over coverage.
Coverage minus premium.
Coverage minus premium. Okay.
The
Now
slope is always negative, so negative sign is there.
Yeah. So premium is your -1. Coverage is 100 -1 is equal to -1 by 9. Okay.
Even
Thank you,
now
Abhineet.
you can even choose for, let's say you are paying the premium. Let's say you are paying how much premium was there? 500. So 500
Yes.
upon 50,000 minus 500.
Yes. Okay. Shall we move to next question? Okay.
Yes, we can. Yeah, clear.
Okay. Simran has an income of 1,000 units, which she spends on 2 goods. Good one costs ₹50 per unit. Good 2 costs 100 per unit. Simran's utility function is this, root x1, x2. So what is the slope of the budget line for Simran? So budget line is always, so there are two goods, let's call them X and Y. X costs 50 per unit, so it is 50X. Y costs 100, and whatever the amount she spends on this, it is always less than equal to 1000 because that is her total income. So this is your budget line. So to find the slope, what you do, just make it Y is equal to 1000 by 100 minus 50 over 100 into X. So this has come, Y is equal to mx plus c. M is the slope. So from here we can see the slope is minus 50 by 100, which is minus 1 by 2. Okay. Now, second, suppose Simran was consuming 9 goods earlier of X, 4 of Y. Now she reduces her consumption of X to 6. If she wants to be as well off, so this is a thing here, as she was before, how many units of good 2 does she consume now? So see, her earlier utility was 9 into 4 root, because her utility function has been given, is 6. So to maintain the same value of condition, now root 6y should also be equal to 6. So from here we get y is equal to 6. And here only I will try to cover, okay, in the next question it is coming. Okay, what is Simran's marginal rate of substitution when she is consuming the bundle 9-4? So MRS formula is, MRS is delta U minus of delta U by delta X divided by delta U by delta Y. This is the MRS. And this is also equal to P1 by P2. If question comes for the price. So MRS is this. So utility function has been given. We take delta U by delta X, which comes 1 divided by, Y divided by 2 root xy. And then we take for Y, it will come X by 2 root xy. So we put it in the formula, we will get minus Y by X. So Y and X values have been given, 9 and 4. So we put the values Y minus 4 and 9. So answer is minus 4 by 9. Now the next question is, what would Simran's optimal consumption bundle be? So we know the budget line is 50x plus 100y is equal to 1000. We also know the formula that MRS is equal to minus P1 by P2. So we have already calculated MRS is minus Y by X. So this will become from here. Now P1 and P2 we know, it is given in the question that they are 50 and 100 respectively. So from here we get X is equal to 2Y. We put it in the budget line formula and we get the value of Y. So Y becomes 5, and then using this we get the value of X. So these are two important formulas to remember. MRS is equal to minus delta U by delta X by delta U by delta Y, and it gives the slope of the budget line. Second, it is also equal to minus P1 by P2. So these are the
this thing. Actually,
Yes.
MRS is slope of the preference, the indifference curve, the utility curve.
Utility curve.
This P1, P2 is the slope of the budget.
It is the budget curve. So it is both. It is the same. It is the place where it is meeting. So it is your budget line, and this is your utility. So where it meets, that is the slope.
Slope, right.
Yeah. Okay, next question we come. Ramesh is a risk-averse individual who maximizes the expected value of the square root of C. So his utility function is given, U is equal to root of X. Ramesh has a 50,000 in safe assets. He also owns a house that is located in an area which there are a lot of forest fires. If his house burns down, the remains of his house and the lot it is built on the would be worth only 40,000. So this is state 1 when it burns. Give him a total wealth of 90,000. So state 1 is 90,000. House plus this. If his house does not burn, it will be worth rupees 200,000. Total wealth will be 250,000. So this is your state 2. The probability that his home will burn is 1% only, which is 0.01. So what is Ramesh's expected utility if he does not buy insurance? So if he does not buy insurance, so in case of fire, he is left only with 90,000. So we use the utility which is root of x. So utility is 300. No fire, utility is root of 2,50,000, which is 500. Use the probability to get the expected value, which is 0.99 into 500 plus 0.01 into 300, we get 498. This is the case when he does not take insurance. Okay. What would be the certainty equivalent of the lottery he faces if he does not buy fire insurance? So this, I feel that there is a typo here in this question because there is no lottery here. So what I could make out that certainty equivalent of his wealth, that what is the wealth he'll be having in both the scenarios. So it is 0.99 into 2,50,000 plus 0.01 into 90,000, which becomes 2,48,400. Now the next part is, suppose that Ramesh can buy insurance at a price of rupees 1 per 100 of insurance coverage. For example, if he buys rupees 100,000 worth of insurance, he will pay 1,000 or to the company no matter what happens. But if his house burns, he will also receive 100,000 from the company. How much insurance should Ramesh buy so that he will be fully insured in the sense that no matter what happens? So what we do, we assume that Ramesh has bought an insurance for rupees X, for example. So his, for example, this is the premium he has paid, X. So his insurance cover will be 100 into X. So in the case of no burning, he starts with 2,50,000 minus X, no burning, and he gets, it is his value of the entire property plus house. So 2,50,000 minus premium which he has paid. Now, in case of burning, he starts with 2,50,000 minus X. Everything burns down, so he loses 2,50,000. Only left is 90,000, which he gets, and he gets 100X from the insurance company. Now, his returns from both the scenarios should be same in case he wants to be fully insured. They're asking. So we quit this 2,50,000 minus X. So this will become 90,000 plus 99X. And from here, X, we get 1,600, which is the premium. And if he's paying 1,600 premium, he should take insurance of 1,600 into 100, 1,60,000.
So I think one doubt, I was solving it in a very, another way. I was taking that he gets 2,50,000 if he has a full cover. I mean, if he doesn't have, if there's no accident, he gets 2,50,000, right?
No, 2,50,000 minus X because he has paid a premium.
Okay, no, the way I was taking was, the question asks that how much more insurance should he require? So this thing is 2,50,000 he's getting, and if there is, if the accident happens, then he gets 90,000. So the cover should be 2,50,000 minus 90,000.
Okay.
For full cover.
Yeah. So that is also, Madhi, if you want to take a shortcut, that is the ideal that he should, in both the scenarios, he should get the same amount.
Right.
So he should take that insurance in which in all the states he get the same amount.
Same amount. So I was calculating like that. I didn't say no, I did this.
So next question is the same. If Ramesh buys full insurance, the certainty equivalent of his wealth is what? So see, the same concept has come that in both the scenarios, his value will be the same. That is 2,50,000 minus 1,600 in the both. So there is no probability. So straight away, in all scenarios, it will be 24840. Okay, the next question is also on the same concept. So let's revise it. Shahid owns an apple farm located near the Himalayan mountains where landslides happen occasionally. Shahid sells the apple in the market at the end of October. If there is no landslide, so state 1, no landslide, he can earn a profit of rupees, I think it is 10 lakhs. Yeah, 10 lakhs. Or it is 100, 10 lakhs. If there is a landslide, In the nearby mountains, 75% of his farm is affected and he can only earn a profit of rupees 40,000. So these are two states. Shahid can buy landslide insurance at a cost of rupees 5 for each 100 worth of coverage. Shahid estimated probability of landslide is 5%. Shahid expected utility function is also given. UCL CNL is equal to 0.05 root CL plus 0.95 CNL. Where CL is the consumption when there is a landslide and CNL is the consumption when there is no landslide. So they have given in this question. Otherwise, okay, this utility function directly comes. If they don't give, then also if we form our utility function, we will get the same. So again, we come to the same state that, for example, no land. I take back my words. This root CL they have given. Otherwise, if we would have done, then we would have taken only CL. So they have given the utility function root. So if there is no landslide, probability is 95%. He gets 10 lakhs. So in that case, his utility will be 0.95 into this, which is 950. In case of landslide, it is 40,000. So his utility is 10 only. So his expected utility is 950 plus 10, which is the first question. Second question is, now Shahid insures for rupees X. So he's insured for rupees X. Then if there is a landslide, he gets X in insurance benefit. He has to pay the premium whether there is a landslide or not. Given these conditions, which of the following represents the state contingent budget constraint for Shahid? So, for example, we say, oh, I have made some mistake here, I think. If he insures for rupees X, so his premium will be X by 100. So he's paying cost of rupees 5 for each rupees 100. I think, Abhinit, I think I have made a mistake here. X by 20. X by 20. It will be X by 20, no? This will be X by 20. Because he's getting 5 rupees and 100 rupees insurance.
Right, X by 20.
Okay, so it will be X by 20. Okay, so I will correct it here also. Here also. And just Vivek, your thing was also correct, okay? Because when you equate it, whatever you put, it gets cancelled out. Okay. So we take both the states okay, conceptually. So he has paid insurance, he has insured for 5, premium he has to pay X by 20. So in no landslide case, he will be left with 10 lakh minus X by 20. It is the value with him. In the case of landslide, he pays this premium. So he starts with this. He loses everything minus 10 lakhs. And he is left with only 40,000. And here he will get now X. This will be X. So he gets X insurance he has got. So in both the states, they have to be same. So when we equate this, both the states, so this X by 20 will get cancelled, 10 lakh will get cancelled. And from here, we get X is equal to 10 lakhs minus 40,000. So Vivek, if we take your thought also, he should always insure in the no fire state minus fire state, whatever the amount is there, he should insure for that.
Right.
So in this case also, yes. So in this case, okay, this one also. So he will get this, okay. So now what is Shahid's marginal rate of substitution? CL and CNL they have given. So we straight away use the formula that minus du by dCl, dou u by dou CNL. It has been given. We use the derivatives and we get the answer minus 1 by 19 CNL by CL. Now, at the optimal point, what is the ratio of the contingent consumption CL by CNL? So at the optimal point, your MRS which you have calculated, and this is your expected budget constraint that his value will be 0.05 CL plus 0.95 CNL comes 9,52,000. So from here, if you take the slope okay, is coming minus 0.05 to 0.95. Now this slope has to be same as what we have calculated here, MRS. So when we take MRS is equal to slope, we get this is minus 1 by 19 crosses, and we get CL is equal to CNL. Is this okay, Suraj?
Yeah, it's fine. Like I have doubt in 12th question only.
12th. So shall we cover 12th again?
Yeah.
Okay. So see, Sahid has got two states. One state is landslide, no landslide,
Okay. Okay.
no landslide.
Hmm.
Second is landslide. The
Okay.
probability is 0.95, no landslide. No landslide is 0.5. And his utility function they have given is 0.05 root CL plus
Yeah.
0.95 root CNL. So
Yes.
this is a landslide, this is no landslide. So in case he does not purchase any insurance, then his utility function will be what utility will get? 0.005 into root 40,000
Yes, exactly. Yeah.
and 0.95 into 2,50,000 ka 500.
Yes.
Okay. So here, this is the utility when he has not taken any insurance. Now, second question they say that if he insures, and they have given that Shahid can buy the insurance at a cost of rupees 5 for each rupees 100. So now they say that Shahid insures for rupees X, and if there is a landslide, he gets this amount X in insurance benefits. But he has to pay the premium. Premium will be X by 20. From here we can calculate
Yes,
whether
exactly.
there is a landslide or not. Now, given these conditions, which of the following represent the state contingent budget constraint for Shahid?
Sir, I think his doubt would be because we have to give the equation of the state contingent.
Okay, state care. So
We've
can
actually done the maximum.
yeah. So
coverage.
yeah, can we check what is in the GA? What they're asking?
Yes.
This is question number 12. Oh, sorry, I opened ATB. Actually, both ATB and corporate finance now they have really too much. Don't take this combination.
I have taken that.
I've also got. So this is 12. Okay. Okay. So this is the state ticket. He insures for rupees X, what he gets in insurance benefit he has to pay. So see this question, and with this question and the option which they have given, there is no relation with the insurance.
Yeah.
Okay. So the only the state contingent budget constraint they have asked. Okay, that's why I did it here also.
No, I think the next question they asked for the coverage.
In the next question they have asked. Okay. Next question
maybe
also they have
नीचे,
asked. इसमें भी नहीं
somewhere
पूछा.
I saw, maybe lower.
Yes.
Yeah,
Question
yeah,
number 15 they have asked.
Yeah.
15 they have asked. So here this so budget constraint, if we see, budget constraint is how much he is getting. So 0.05 into 40,000 plus 0.95 into 2,50,000, and we calculate this 95200. We have calculated somewhere. I think, see, this is the one. Budget constraint is this.
Yeah. That I understand. Initially, you said like when there is no insurance or something.
Yes. Okay. Now we get a similar question now. John has choice of two assets, a risk-free asset. Okay, this is a different. So from here, different section has started in week 6. New topic. Unfortunately, our professor, he never covers like this. He is so monotonic. We don't even come to know Some new topic has started.
Exactly.
Some new concept has started. Okay. So from here, this is a new concept and which goes till week 8. So it has started from here. So John has a choice of two assets. There is a risk-free asset. So remember, risk-free asset, what does it mean? That variance is 0 in the risk-free asset. Because you are supposed to get that fixed amount, whatever you are there. That offers a rate of return is 10%. And there is a risky asset which will have your variance will be greater than 0. A that has an expected rate of 25% and a standard deviation of 10%. John invests 40% of his income in the risky asset and the rest in risk-free asset. What is the average rate of return of John's portfolio? So this is covered. So your expected return when there is a risky and there is non-risky. I will cover it like this. So expected return will be from non-risky. It is always you will get the same amount. Okay. So if he's saying,
That's it.
so we never use expected with non-return. Okay. Because it will give the same rate. So we, for example, we say it is RF, risk-free. And you have invested, for example, W in this. And this will become 1 minus W. And when it is risky, we always say expected. So this is risky. And let's say it is, I write like a RR. So this is the formula for your return. So now they have given W also, they have given RF also, they have given RR also. So everything has been given. We have to just put it in the formula. So 40% is in the risky. So 40% is in the risky. The rate is 0.25. Balance 0.6 will come to risk-free, which is 0.1. And expected becomes 16%. What is the standard deviation? So like I covered it here, standard deviation for risk-free is 0. Otherwise, the formula for this, I will just take a minute just to cover it here. So if there are two assets, asset A, asset B, this is sigma A, this is sigma B, this is the standard deviation. So you invest W1 in this and you invest WA in this, you invest WB in this. So your portfolio when you make and the combined portfolio, I say this sigma square portfolio T will be equal to WA sigma A square plus WB sigma B square plus 2W1 WA WB sigma 1 AB. Okay, this is the formula, easy to remember, like our normal quadratic equation. Now from here, what we can derive, this sigma AB, or this is a covariance of AB. This is, we know that correlation factor which is there, AB is equal to covariance AB divided by variance, standard deviation of standard A and B. This is the formula. So the same formula can be written as WA square plus WB square plus 2 into WA WB, and you can take this correlation of between AB into sigma A into sigma B. So this is the basic formulas for week 7 and week 8. So I just wanted to cover here only. Now in case of risk-free, your this sigma A is 0. Only and there is a sigma B. Okay. So with this concept, we come to this question. Okay. So see, it is sigma 1 W1 square plus sigma 2 W2 square, and this is 0. So we use only this term 0.4 square into 0.1 square is equal to sigma square. and we have to find the standard deviation. So it will become 0.4 into 0.1, which is 0.04. Now, what is the slope of the budget line for the Jones portfolio? So your expected, which is there, it is 0.6 into risk. You have invested okay, some amount in risk free, 0.4y in some risky, and this is your whatever you had portfolio. For example, you wanted to spend 1 lakh, so you have invested in this proportion. So again, what we do, we make it into the mx y is equal to mx plus c format. So we get y is equal to k minus 0.6, 0.4. So slope becomes 1.5. Now the last question of week 6 is, John observes a new risky asset B that has an expected rate of return of 30% and a standard deviation of 15%. So what he should do? He should prefer the asset B or prefer the asset A. So in that case, there is something called mean and variance ratio. So what we do, we find this mu by sigma for both the investments. So mu we know, and we know the sigma. So we find out, and whichever is higher, we will invest in that. So in this case, the A remains higher. So we can check that also. So A was 25% mu and 10%. So 25 by 10, and in this case, it is 30 by 15. So this is 2.5 and this is 2. So 2.5 is greater than 2. Therefore, he should remain invested in asset A only, not on B. Is this correct, Vivek?
Yeah, absolutely. But usually in industry, they put the Sharpe ratio also. But
Yes,
it actually cancels out because it's the same, the risk-free rate.
Yes. So now we'll come to the Sharpe ratio also in week 8. Okay. So from these three, I think in week 6, around 15% of the content was on this. And the same content is now continuing in the week 7. So we will see in the week 7. So week 7, first question is Jacob. So they have changed John to Jacob. Jacob has a mean variance preferences represented by the utility function u is equal to mu minus 3 sigma square. So this is a utility function. He is considering two assets A and B. A has this return with 0.5 probability and a 20% rate of return with 0.5 probability. Whereas asset B has a 15% rate of return with 0.75 and minus 5% rate of return with 0.25 probability. So what do we do? Which asset would Jacob prefer? First of all, we find the expected for both A and B. And then we use the utility that function also, from there we can come to know. So first they have which asset would Jacob prefer? So E of A, use the probabilities, his what he's getting 0.5 and 0.05 and 0.2. So in A he gets 0.125, in B he gets 0.0125. And we also find the sigma also, the variance also. So variance for the first, we find the probability 0.5. We found out with 0.125. So variance of this A is 0.075. And now fit it into the utility formula which has been given in this question. So we find the utility of A, which is 0.125 minus 3 into 0.075 square. The same exercise we do for B. And we find out that utility of A is greater than B. So again, I'll cover the steps. We find the expected for A and B. Now use this expected value and the different scenarios to find the variance. Now we know this is mu and we have found this variance. Utilize this in the utility function to get the utility of both. And whichever investment or whichever the choice is giving a better utility function, we will go for that. Okay, now we go to next question. So Jacob has a utility function u is equal to mu minus 0.5 a into sigma square, where a is the risk aversion coefficient. Which of the following statement is correct?
Hello?
Hi, Vinit.
I guess, no, I'm sure it's like, I guess screen is stuck. Huh?
Uh, okay, shall I?
No,
Ha,
it's
now
okay.
it's visible. Now it's
Yeah.
fine. Yeah.
Okay. So Jacob has utility function of this, where a is the risk aversion coefficient. Now, which of the following statement is correct? So if Jacob risk aversion coefficient is 50, he would prefer asset over B. So again, what we do, we know the mu and sigma square for A and B, and you fit it into this new utility function, and with the different combinations like 50, 30. So in all the cases, his A remains the same. A is greater than B. All here it will not that. In the is 10, he would prefer asset A over asset B. So we have to put again those values which we just found out in question 1 to find this. Okay, now next question. Assume there are no costs associated with short selling. You exercise short selling on 100 units of ABC shares, which is trading at rupees 500 today. The ABC share prices drops to 450 in the next period. What is the rate of return that you earned on this investment? So in GA, I had done this incorrectly. I had written 11.11. So then I did my own research, and what I found out that when you purchased at a price of 500. You took it on the loan at 500. So it was minus 500 was your, so minus 50,000 was your investment. And then you sold them in the market for 50,000, but this minus 50,000 remains secure in the for the concept wise. Now you again purchase this for 450, that is 450 into 100, 45,000, and you gave it back on the loan. So your profit will be minus 50,000 minus this 45,000, and this was your initial which you had taken on loan, because you didn't know whether you will earn profit or you will go in loss. So here your initial value will always come this 50,000. You made a profit of 50,000. This is minus 50,000, and from here, okay, you get 5,000 divided by this is minus minus. So minus minus cancels out. 5,000 by 50,000, which is 10%. So this I will recommend just uh, just study about short selling and the profit.
In this one doubt, like whenever the selling is happening, we should consider as minus. Huh?
No. When you are taking a loan, it is minus. So in what? How does short selling happens? Okay, so short selling principle is like that. There are, for example, share is for 500 rupees. So you borrow this.
Okay.
You borrow this one share for 500. You have borrowed this. Now second, now you sell it. So when you borrow, you are in a minus 500. Now you have sold
Yeah,
it.
exactly.
Now you have
Mm.
sold it for 500, and
Yeah.
after a month, or after some time, now when the price drops, it is available for 450. So you purchase
Mm.
this. Now you purchase this for 450 and return one share, the share. Okay. So this is the entire cycle of your short selling.
So short selling process is like first borrows and does, right?
Yes. So you have borrowed, you have
Mm.
sold it for 500. Now here you didn't know whether it will come down or go up. If it goes up 600, then you're in loss. Okay. So due to this borrowing only, this minus 500 is coming. Okay.
Mhm. Okay.
Perfect. Okay, now we come to next question. Okay, suppose there are three assets. These are the return of rates. These are the standard deviations, and there are also have given covariance of all three. All three they have given. So first, a portfolio is formed with weights like 25% of the wealth in asset one, 25% in asset two, 50% in asset three. What would be the expected rate of return of the portfolio? So straight away, what we do, we just put the weights and the expected returns. So we get this. Second is, what would be the standard deviation of the rate of return of the portfolio? So the same formula which I told earlier, now this will be applicable for three assets also. So if there are three assets, then sigma square P will be equal to, you can write a short form, Wi into sigma I square, for I is equal to 1 to n, plus 2 into Wi Wi Wj sigma j, where I and j are crossing. So if you expand this, so you will get W1 sigma 1 square, W1 sigma 2 square. This is Ij, sorry, this was my typo. Sigma 2 square plus W3 sigma 3 square, and then you put 2 outside and you will get W1 W2 sigma covariance 1 2, W1 W3 sigma 1 3, W2 W3 covariance of 2 3. So this is the formula. So just putting all the values in this formula, we get the answer. Okay, next is about risk averse. Risk averse investors often choose companies from different industries for their portfolios because the correlation of returns is less than if all the companies came from the same industry. So this is true. So this has come from the part of the lecture where professor had covered to how to reduce your risk by diversification. But you should always diverse in the assets. For example, if you've got only one asset and its sigma square is known, so then if you invest, okay, for example, in two companies with different variances, then your overall variance which is there, it reduces. So it is by diversification. But remember, when you do the diversification of your portfolio, your assets, they should not be correlated, positively correlated. It means that if it is moving in this direction, it is also moving in this direction. So there is no point in diversifying in the assets with correlation of +1. Okay, so this is the concept. Am I right, Vivek? Any addition to this?
Absolutely correct.
Thank you. Now we come to the next one. There are two stocks A and B available for investment. Stock A has an expected rate this, standard deviation is this. Stock B has an expected rate this, standard deviation is this. So they both are risky because they both have standard deviations. The correlation between the rate of return on stock A and stock B is 0.5. So they have given the correlation. So what is the expected rate? Same formula, W1 into expected rate, we get this. And the next, they must have asked about the standard deviation. So in the standard deviation, now we use the same formula, but they have given the correlation. So when you use the correlation, this was covariance. So covariance we know is equal to this into this, and we just replace, we know all these values, we put it here and we get the answer. Okay, next question. What happens to the expected rate of return of 30/70% portfolio if the correlation between the rate of return decreases to 0.2? So see, in the expected rate of return formula, there is no place for either the standard deviation or for the correlation. So your expected rate will remain the same. Only your standard deviation will change. Next question, what happens to the standard deviation of the rate of return of 30 to 70% portfolio? The correlation between the rate of return is decreases to 0.2. So straight away, without going into calculations, we know in the formula we had something and we had this 2 into all these values into correlation. So if your correlation is decreasing, so this full value will decrease. So from here only we can give the answer. Okay, and to know the value, we put the formula and we come to know the answer. Okay, next question is, suppose you would like to construct a portfolio with an expected rate of return of 18.5, what weights you would put on stock A and stock B? So we know what are the rate of returns. Rate of return for A is 15, for B is 25. So what you do, you say that I will put W in this A and 1 minus W into this. Solving this simple equation, we get the W for both. So we get W for this, and then I do 1 minus W, then I get. So I get 65% and 35%. In my own experience, this week 7 and week 8, they are very, very heavily mathematical calculations heavy. The calculations are easy, but in the quiz for 45 minutes, and if they even give like 4-5 questions like this, I'm telling you, entire time will be gone. So I got that hunch. Now, question number 12.
Exactly.
Yeah.
Visit
That's
to
why
previous
today.
previous papers.
Yeah, that's why today I asked you, how do you use the calculator? Because we have to use the calculator efficiently.
Log. Yeah.
Yeah. Okay. So what is the standard deviation? So straight away we put the same values we get. Only this is that this takes. And another thing, unfortunately, they are in decimals. Only if they would have been integers, we could have solved them easily. Okay. What is the standard deviation if the minimum variance portfolio consisting of stocks A and stock B? So this concept is what? Minimum variance. Minimum variance means that now we have found out that variance is W square P square is equal to W into sigma 1 square. The second will become 1 minus W into sigma 2 square into 2 into W into 1 minus W. I'm just placing W1 and W2 and into this we have got into covariance of AB. So if this covariance is given, then we can easily find out. But if we have to find these W's for the minimizing covariance, so that is known as the least variance. So what we do, we have got these values, so we expand them in terms of this W. So we'll get some W square, we get some value W, we get some like a number. So then we take the derivative of this with respect to W. So then we'll get a linear equation. We'll get something, some value W plus or minus some value. So from here, we can get the W star. So this W star is the W for asset A, which minimizes your variance. And correspondingly, W2 will become, this is W1 star, W2 will become 1 minus W1 star. So there is a formula also for this, but if you forget the formula, straight away you can use this also. From here also you will come to me. I'll just share the formula. Okay. So this we've done. This part we've done. So minimum variance. Okay. So this is the formula. See, WA star is equal to variance of B minus covariance of AB divided by variance of both sum minus 2 of covariance of AB. So easy to remember इसमें that when you are taking WA, so on top you take B square and just use AB, and on down take everything A square plus WB square and minus 2 sigma A. But in case you forget this formula, then you can do by solving this equation also. There is no problem. So you put okay, W and 1 minus W, you solve this, take the derivative, put it is equal to 0, and then you can get the W. Okay. Now we go to next question. Shikhar is planning to invest rupees 5 lakh in a beach resort. He believes that he will earn rupees 10 lakh in the revenue next year if normal conditions prevail. If there is tsunami, the resort will be closed down for some time, and he will earn rupees 2 lakh only in revenue. There is a 20% of probability of tsunami next year. Shikhar has an option to buy insurance which costs rupees 0.20 for coverage of rupees 1. The insurance pays the coverage amount in a case of tsunami and nothing otherwise. What amount of coverage will minimize the variance of his return? So see, this is a different question. They are asking how to minimize the variance. So what we do, we say that let's he take insurance for 5x. So then he pays the premium X. So we take both the scenarios, no tsunami and tsunami. So in case okay, he gets the same amount in the both the states, we have minimized the variance, then variance is 0. Variance happens only when the values are different in both states. So what do? We have to find that amount which by which in both states you get the same value. So see, in case of no tsunami, he is investing 5 lakh. So minus 5 lakh has gone. Then he has paid off premium minus X. And then he is earning 10 lakhs. So his final state is 5 lakh minus X. In tsunami state, he invests same minus 50,000 minus X. This is his investment. And he gets only 2 lakh return. And he also gets an insurance of 5x. So this is 4x minus 3 lakh. So in both the cases, if it is same, then we equate and we get x is equal to 1,60,000, which is the premium. And therefore the insurance amount should be 8 lakh. So if he does like this, then in both the cases, his return will be same, which will be 3,40,000. So with this, we have made the variance is 0. Is this okay? It's clear?
Yes, clear.
Okay. But the question is same. We have followed the same concept, only they have just asked the minimize the variance. So earlier also we were minimizing the variance. In earlier cases also the variance was 0. So we have used the same concept. So what is the corresponding expected rate of return? So what we find out, no tsunami, then his expected rate of return is 10 lakh minus 5 lakh plus 1,60,000, which is point, because in both now his expected return will be same in both the cases. So you just equate with that. You can just do 3,40,000 also, divided by 5 lakh plus 1,60,000, and it is comes 0.5151. Next question is, suppose there are 3 assets R1, R2, R3, sigma 1, sigma 2, sigma 3. They have given covariance also, and now they have asked the question is, what are the weights for these assets in the global minimum portfolio? So this I will solve again, this global minimum again that, and I will cover the concepts also. So see, for global minimum scenario, first of all, we have to see that his sigma square, which is there, his variance, which is there, it is weight 1 into sigma 1 square plus weight 2 into sigma 2 square plus weight 3 into sigma 3 square plus 2 into all this sigma 1 2, sigma 1 3 and sigma 2 3 Fortunately, in this question, they have given 0. So your variance of this in the global minimum portfolio, what we have to do, we have to minimize this variance. So this sigma square, the problem is that minimize sigma square, which is equal to W1 sigma 1 square, we can write down 0.04 plus W2 is 0.01 plus W3 into 0.04. We have to minimize this, number one. Second is that such that we know that condition W1 plus W2 plus W3 is equal to 1. So when we have got two equations only and three variables, so then we use Lagrange. We had learned this again in our machine learning foundation. So what do? We make the Lagrange. So Lagrange function will become like that 0.004 W1 plus 0.001 W2 plus 0.04 W3 minus sigma, this is the Lagrange coefficient, W1 plus W2 plus W3, and this 1 comes here, minus 1. So this is your Lagrange. And what do? You take the derivative of this Lagrange with all the variables which are available and equate it to 0. So first you do with respect to W1. So you'll get only 0.04 minus, sorry. I had,
Should be
W1 square.
minus.
W1 square. I had forgotten this.
Yeah.
है ना? This I had forgotten. Yes. So this will become 2 into 0.04 W1 minus sigma is equal to 0. So therefore, this lambda is equal to 0.08, number 2. Similarly, when you take delta L by delta W2, it will become 0.02 W2 minus lambda is equal to 0. Therefore, lambda is equal to 0.02 W2. Lagrange by W3, it becomes 0.08 W3 minus lambda is equal to 0. So you get lambda is equal to 0.08 W3. So now we can solve this 2, 3, and 4 easily. So lambda are equal, so it means 0.08 W1 is equal to 0.02 W2 plus 0.08 W3 equal to, sorry. So see, it means W1 is equal to W3 and W2 is equal to 4 times of 2 for the 8, W1. Okay. But we know W1 plus W2 plus W3 is equal to 1. So we can write W1 plus 4 or W1 plus W1 is equal to 1. Therefore, W1 is equal to 1 by 6 is equal to W3. And W2 is equal to 4 into W1, which becomes 4 by 6 is equal to 2 by 3 is equal to W. So this is how you solve this. Is this okay, Lakshman? So I think this was the last question of question 7. This was, you see, what is the expected rate of return? So now we know W1, W2, W3, we put it in the formula, we get this. What is the standard deviation? We know all other values are 0 here. So we put find the variance and take the root of this, we get this. So friends, okay, with this, okay, I have finished week 7 and I think it will become too heavy if I do the week 8 also today. So can we postpone week 8 for tomorrow anytime, somewhere in the evening?
Yes, it will become heavy. Otherwise.
Yes.
Otherwise it will become too heavy.
Yeah.
So I think we
true.
we can assimilate this today.
Thank you.
Yeah.
Thank you so much.
Yeah, thank you. And any
Thanks a
input
lot,
from
yeah.
anybody's side? Okay, anything anybody wants to join? Vivek, thank you for joining.
Yeah.
Jalaj, Suraj, thanks a lot.
Thank you.
Yeah, and I'll
Thank
share
you.
this.
Thanks a lot for taking this session.
Yeah.